Right, what's your assessment now of what's been going on? I came in this morning at lunchtime and all the markets were up. It's almost as if, like the English weather, the mood changes with the latest bit of news and it's almost over-analysed and responded to.
You're right. Well, I think this is one of the drawbacks of living in this ever-converged world. The fact that there's so much information at your fingertips. And over the weekend, of course, as you know, we had this seeming resolution to the whole banking crisis in Europe, with the news that it's only going to cost about 100 or 125 billion to bail the Spanish banks out. It's ridiculous. But in the Far East this morning, I mean, they were very happy about it, and of course they were up considerably. As the day wore on in Johannesburg, you know, we started off well, as you were saying, and we started, I think, to see a bit of a move out of retailers, for example, into resources. You know, people were thinking resources looking quite cheaper, and then it all fell out in a bit of a heap. I think one of the keys to this may be the fact that there's a growing amount of research coming out about India. Now, they have now seen they're looking at scaling their economic growth back from about 6.9% this year to about 5.3%. You know, if we had 5.3%, it would be fantastic. But in a situation like India, you know, we have had such monumental growth for so long, to see it being scaled back this much, and coupled with the likelihood that they're going to see a ratings downgrade as well. So that, I think, has put a bit of a fear into emerging market players. And I think we're bearing the brunt of it as well. And
the mixed signals, or the mixed response rather, from the Chinese rate cut. Some people saying if they have to do that, that's bad news, and others saying, well, the fact that they're doing it is good news. I was talking about Mark Mobius earlier. He's just put out a note saying Brazil, have a look there, because their growth has dropped quite dramatically. 7.5% in 2010 down to 2.5%. Yeah. Wonders whether Brazil is still competitive. So now it's three of the emerging markets we suddenly got questions about.
Yeah, they're starting to look a bit wobbly. When we saw that rate cut in China, there were a number of observers who were saying, well, look out for some really bad news on the manufacturing front over the weekend. In fact, that didn't materialize. Most of the data we got coming out of China was actually surprisingly good. So, you know, as I say, we're living in this situation where we may be suffering from a bit of what we call analysis paralysis. You know, you're getting so much information and trying to interpret it, inwardly digest it, and actually do something with it is becoming more and more difficult.
Also, where positive news is not positive enough.
Yeah.
The market didn't expect it, like with the US jobs growth. It's a bit like companies in South Africa when there's been a strong run. You say, well, the profit wasn't as much as we thought. It's only 50% up on last year. So expectations perhaps unreasonable, but that's the market.
Well, yes and no. I mean, I was looking at some of the growth forecasts coming out of Barclays this morning, and we look at the US, for example, and we were looking at scaling their forecast back for this year from 2.5 to 2.1%. Now, you still have, that's still the biggest economy on earth. Now, when you start scaling that back considerably, and that's quite a considerable adjustment, then you start thinking, you know, we're not perhaps really coming out of this recession as nicely as we might as we thought. So, you know, you put it all together, David, and I think it's starting to suggest that things are perhaps looking a bit more tepid, a bit weaker than.
But perhaps if there's a strong signal that gives a lead, then we might have a rush of optimism that is founded instead of just reacting to the latest snippet.
No, you're right. And look, we thought we had that at the beginning of the year when we started getting this continuous flow of good information out of the US. But unfortunately, it started getting a bit patchy again. Look, I'm sure that as the year progresses, it will still be, on balance, positive, because in an election year in the US, it's very unlikely that you would get a slew of negative economic factors coming out.
I want to talk to you in a moment about retail, because I know it's the sector that you do probably know the most about, although you know a lot about a lot of the others. Looking at the stocks, if you look at the greens and the reds on the board, a lot of the resources companies are up today. Yesterday they were down, having been up strongly on Friday. Yeah. The banks, quite often we've had all four banks go up, Nedbank up by a couple of percentage points, then they go down. So it's almost as if each of the sectors, when they go up, they correct the next day, either up or down. And the market just seems to be constantly keeping that equilibrium.
That's right. And I think that is symptomatic of a market that doesn't really know where it's going. You know, it's very much a trader's market, a stock picker's market. This is not a situation where you can just go in and buy the whole thing and watch it go up nicely, or for that matter, if you like shorting the market, watch it go down nicely. We're getting it, and it's struggling to get through its previous peaks. So we've gone largely in a straight line for the best part of a year. And you know, so it makes life much more difficult, and as you say, it means that on any given day you're likely to see this kind of reasonable volatility coming through.
And very few of the shares, even when results are extreme, one thinks of a Barlow world, you know, the share goes up then goes down again because people say, well, we're not sure. But let's look at the retail sector. You put out a note, which I saw yesterday or this morning, saying that the foreigners in retail stocks in South Africa are a better barometer of investor confidence than some other measures.
Yeah, I think it's because a lot of the foreigners who buy our retail stocks realize that what you're buying here is something different to what you're buying in Brazil or China or India or whatever, in the sense that you're buying first world management. You're buying retailers that stand comparison with the best retailers anywhere in the world. You know, they're outstandingly good. And at the same time, every so often you get this little flurry of activity that suggests we're an emerging market. In my opinion, we're not a traditional emerging market. We have more of a characteristic of being a developed economy with high unemployment, you know? So that being the case, it's perhaps unfair in many ways to compare us with emerging markets. But having said that, because we're on the emerging market radar screen, you get many of these foreign investors who are compelled to buy emerging markets. We're classified as such, and if they're going to do that, they're going to buy our good ones. And most of them are extremely good. So as a result, you're getting a penetration there of 70% foreign shareholding in Massmart, for example, 40-odd in Mr. Price, and it goes on. There's some very, very high holdings in our retailers. And I think the fact that they haven't sold them, I think the fact that they still have sustained confidence in these retailers says to you that there's quite a residual out there that says, you know, South Africa is actually not such a bad place to be.
You had a phrase, you talked about first world systems and management and reporting, third world potential in the market, and a young market.
Yeah, exactly. I think if you look into the rest of Africa, and it's interesting today. Now I got hold of a report that's been produced on retailers in the emerging world, and we don't actually feature in the top 30, and yet Botswana, you know, retailers appear there, for example, and that's got much more real, more genuine emerging market characteristics, if I can put it that way, than South Africa. The rest of the continent, you know, you have that emerging middle class that's coming through. It's looking at internet, it's looking at satellite TV, it's seeing things, it's seeing brands, it wants them, and it's got the wherewithal to buy them. And it needs to be fed by the retailers.
Looking at the rand there, now these foreign investors obviously must keep an eye on that, and it's been very volatile. It's gone from between R8.22 to R8.60, I think.
Yeah.
In 10 days.
Yeah, that's right. It's fascinating if you watch this, David. You get up in the morning and the rand, for some obscure reason, not only to currency traders, is usually quite strong. And during the course of the day, all other things being equal, it tends to soften a bit. So here we are this afternoon. I think you made the point. It was 8:30 this morning. Now it's 8:40. So it's weakened through the course of the day. It's not as volatile as it has been in the past, but let's not forget, it is probably very much a proxy for emerging market currencies, emerging markets generally. So if the sentiment is anti-emerging markets, to use that dreadful American expression, risk off, then as a result you're going to find investors and speculators, more speculators, actually dumping the rand during the course of the day. Conversely, if you start getting sentiment going positive, then you'll tend to see it strengthening.
But these companies presumably do get reported in rands, and the rand is important to their results, the foreign holdings. So,
yes.
So Anthony was saying earlier on the show that he expects a weakening of the rand, possibly going to 9, that sort of level. Well, then do we look at a withdrawing of the tide in the retail stocks from foreign, if it stays at that level?
It depends on their time horizon. If they're long-term investors, that they believe that you know, once we're past this current bout of uncertainty in global markets, then if they're going to stick with, as I said, that tried and tested formula of really outstanding management, then perhaps not. If they're traders and they feel that the rand is going to weaken, then yes, perhaps you'll see that kind of phenomenon taking place.
What are you going to be looking for in the market? Possibly in the retail sector, but more broadly in the next week or so? We've got the Greece election coming up.
Yep. Well, we've got retail sales figures coming out this week, and that's going to be truly fascinating, you know, to get an indication as to what's happening out there. I'm starting to see a little bit of a dichotomy between the holistic figures as produced by Stats SA and what you're seeing coming out from the individual retailers. Individual retail actuals from the likes of a Foschini, Mr. Price and whatever are extremely good and tend to be an awful lot better, in fact, than what we're seeing as far as the holistic picture is concerned. So, but even so, I think if you look at the Stats SA figures, we're starting to see the retail sales growth coming off. And if that's the case, and if we're looking at a situation where later on in the year or into next year we see interest rates moving up, then it may just be a question of time before retailers start losing a bit of their allure.
Of course, with the rate cut idea, that consumption is sensitive to that in terms of disposable income. It keeps being put off, and I read today a comment by one of the analysts saying if they're going to do anything to interest rates sometime in 2013, it'll be down, not up.
Yes, and I'm starting to see that kind of sentiment coming through as well. I mean, indications on the bond derivatives, the forward rate agreements, are suggesting there's a 50% chance or thereabouts of an interest rate cut. And obviously now the Reserve Bank Governor, Jill Marcus, she has a dual mandate. It's not just price stability. She and the MPC are looking at the state of the economy, underlying economy as well. And if they feel that the situation is deteriorating, and Governor Marcus, she's been very, very accurate over the past couple of years. She has been one of the lone voices pointing out just how really dangerous this European sovereign debt crisis is. If they feel that there's a big danger to growth, there's a possibility. We don't see that as being too much of a possibility, but there's a possibility that they might just cut. Yes.
A broad question: retail stocks said to be high, partly because of that foreign interest. Good shares to have, but expensive at the moment. Also, a broad view that commodities, mining shares are low. Some of the PE levels are 7, 8. Good sector to get into.
We like them. I mean, we put our money where our mouth is. I mean, we have a lot of these, diversified miners particularly. They're looking extremely good value. There is a caveat, and it comes back to what we said earlier on. If we are going to see a significant and secular interruption to the commodity super cycle, then there's a reason why they're so cheap, and they might stay cheap for some time. But if this, in retrospect, is seen as being a blip, and it's something we're going to get over, which we firmly believe is the case, then the value does seem to be quite glaring.
Particularly for the diversified miners, because
Absolutely.
they've got this range of
very
things that they
reasonable.
offer.
Yes.
That was Chris Gilmour from Absa Investments.